Hello, and welcome to the third of three videos which make up this quarter's investment update. In the first two videos, we looked at what has happened recently with interest rates and inflation, which have gone up very, very sharply, and this therefore caused markets to fall very sharply in 2022 and only make a partial recovery so far this year. We also looked at how extraordinary those moves are in historical context and how they were both caused essentially by what happened in the pandemic, which hopefully therefore means that they won't be repeated. Of course, these factors have had a big impact on portfolios. So in this video, that's what we're going to focus on. We'll look at how portfolios have performed in relative terms and what changes we've been making to them to try and capture some of the opportunities that we believe are out there. In this video, we're going to concentrate on the core portfolios for simplicity, but the other portfolios are also shown in the written version of our quarterly investment update if you want to refer to that. So we're going to start by looking at long-term investment performance. Now, of course, investing should always be for the long term, which is why we always look at long-term returns. And this table shows the 10-year returns of our three core funds. So over this period, they're up between 43% and 65% in total. And we can compare our performance to other places you might have invested your money. Those that take a similar amount of risk, for example, those portfolios that are allowed to have a similar amount in the stock market to our portfolios. And the typical balanced fund that can have between 20 and 60% in stocks returned 37% over the same period. Now, of course, you could have invested your money with another wealth manager instead, and the typical wealth manager's balanced discretionary portfolio returned about 38% over the same period. So at the top level, you can see we've done better over the long term than comparable investment managers. Also on the table is what that works out as on a compound annualized basis. And then we also show what inflation has been over that time period. So despite the recent spike in inflation, with it going to double digits last year, over 10 years it's averaged 2.85% per annum. So that means that even with the really difficult market conditions recently, all the portfolios have grown in real terms over that time period. Now, of course, you could have just left your money in cash instead. And here, your total return would have been just 8% over 10 years. So that's 0.8% per annum. So even with the really big spike in interest rates recently, had you got returns in line with base rate, it would have been very, very low returns indeed. So that's the long-term context, which we think is really, really important. But of course, what has happened in the short term has been quite difficult. So what we're going to look at next is how the portfolios have performed on an annualized basis, looking at every one of the last 10 calendar years. So we like to look at things in this basis because this allows us to show how consistent returns have been in relative terms, but also the behaviour of the different portfolios, how they perform in different market conditions. Now, of course, there's a lot of data on screen, but essentially the green numbers show where we outperformed. Unfortunately, we can't outperform all the time, and we can't avoid the short-term losses because losses, unfortunately, in the short term are an inevitable part of investing. But in summary, Cautious has outperformed its benchmark to 7 out of 10 years. Balanced and Adventurous, which can hold more in stocks, have outperformed 8 out of the 10 years. And they're also outperforming so far this year, and we think they're pretty decent ratios. And you can see that when markets go up, typically Adventurous does the best and Cautious might lag a little bit, but when markets fall, it tends to be the other way around. Now, last year, of course, was a poor year. Sharp losses in most of the asset classes that we can invest in. And this year has been pretty mixed as well, to be honest. So the average balance fund has actually lost money again this year, but our balanced and adventurous portfolios have at least gone up a little bit, and they're also quite a lot higher than they were at the lows of October last year. So what's happened this year is that equities have typically gone up, though not all types of equities by any means, whereas bonds and some of the other assets like real assets like property and infrastructure have continued to struggle. So Adventurous and Balanced can hold more in equities, whereas Cautious can't hold as much, and therefore the losses on some of those other asset classes have had more of an impact. And we can also see that if we look at the various other time periods that we see in this table. So all the portfolios are slightly down over 6 months, and here you can see that Cautious is again finding things slightly more difficult because of those real asset and bond exposure. But over 12 months or longer, all the portfolios are at least back in positive territory. And again, you can see that balanced and adventurous have outperformed across most time periods. In fact, adventurous outperformed across all of the time periods we're looking at here. So let's have a look at what has been driving the portfolio returns recently. So in this table, what we're showing is how the different asset classes within the portfolios have performed over the last 12 months. So these are the returns of the underlying funds that we hold within the balanced portfolio. Now it will be slightly different in some of the other portfolios, but it just gives you an idea of the direction of travel. So over the 12 months to 5th of October, you can see all of them have gone up somewhat, with the exception of real assets. So as I said before, that includes assets like property. And here, the rising borrowing costs as interest rates have gone up have had a really, really big impact. It also includes infrastructure, where we've got a big proportion in clean energy, and also it includes forestry. And both of these have been hit not just by those rising interest rates, but also by the sort of backlash that we've seen against some of the environmental legislation. So for example, with the UK government pushing back their net zero goals, and that has really hurt some of these asset classes. In our portfolios, our fixed interest exposure, which is largely corporate bonds rather than government, has actually done okay. So it's almost kept up with equities over that time period. Alternatives have been mildly positive, but actually the standout performer has been defined returns, and these have outperformed even some of the best performing stock markets over this period, more of which in a minute. So now we'll add to the table the proportion we hold in each asset class in the balanced portfolio now and what we held a year ago. And then the arrows show the changes. So as you can see, the big change is fixed interest, where we've almost doubled exposure over 12 months. Again, I'll explain why in a moment. That's been funded by reducing all asset classes, especially alternatives and real assets, but also some equity. And that's because we topped up equity last year, in particular buying a Nasdaq tracker in many portfolios. But as markets have risen, we've then sold that again and banked some of those gains. Now you can see defined returns exposure has actually gone down over the year as we've had a few products kick out, but it's now on the way back up. But before I talk about the prospects for defined returns and about equities in general, I'd like to talk about bonds. Now, one of our core beliefs is that we should constantly rebalance the portfolio. Essentially, as something falls in value and becomes cheaper, we tend to top up and keep topping up on the way down. Whilst if things go up in value and become more expensive, we tend to sort of bank some of those gains as we get them. So constantly rebalancing. And when we look at bonds, there is a clear reason why we do that. Because as the price of a bond goes down, the yield goes up. And what that means is the future expected return of those bonds also increases. Now, unfortunately, some of that rebalancing can actually make things worse in the short term, because unless the purchase that we made of an asset class is right at the very, very bottom, if it keeps falling, then unfortunately, by buying on the way down, we've actually made things worse in the short term. But what we believe as it also does is that it adds to the long-term potential returns. And for bonds, the yield gives you a really good indication of what those long-term returns might be. So for example, this chart compares the 10-year returns of gilts over various historical 10-year periods to the yield, the gilt yield at the start of the 10 years. So each dot is a different 10-year period for gilts, and the higher the dot is on the chart, the higher the annualized return was over those 10 years. Across the horizontal axis is the yield. And the dots form a clear pattern from bottom left to top right. So when you begin with a low yield, you tend to expect a low return. When you start with a high yield, you get a high return. It's pretty simple. Now, 2 years ago, a 10-year gilt yielded just 1%. And we've now seen some really steep falls. They've fallen such a long way, the yield has actually gone up from about 1% to about 4.5% today. And we've circled on this chart past periods where the yield has been at about those levels. And often what we've seen is 6% or more historically when yields have been where they are now. And other types of bonds actually yield a lot more. So corporate bonds, the yield is more like 6.5%, and we can get closer to 10% yield on high yield bonds. So these are riskier, but a similar principle applies. The yield gives you a really good idea of what the potential return might be. And with yields that high, we think the potential returns are really quite attractive. So we'll shortly be publishing our long-term investment assumptions. Now this is a study we do every year where we look at data such as that yield chart that we just showed you and try and work out what the long-term expected return for all the different asset classes might be. Now the headline this year is that bond expected returns have gone up a lot because those yields have also increased. Equity expected returns are about the same. We think perhaps equities might produce perhaps 10% per annum if you have a diversified mix of equities over 10 years. And that's pretty good. It's a lot more than we'd expect cash to be. But it's not outstanding that we've seen sometimes when markets have been really, really cheap and we could expect returns to be even higher. But here is where we can make some adaptations to portfolios to try and increase those expected returns. So in particular, we can use defined returns to try and boost that expected return. Now, defined returns are structured products and they are created especially for our clients. And these generally pay a fixed level of return over a fixed period, provided markets don't fall. So for example, we've just created a new structural product with Morgan Stanley, where the headline potential return is 12.4% per annum. So that's higher than we expect equities to return over the long term. And this is based on both the FTSE 100 and the S&P 500. And provided those markets don't fall over a 5-year period, we should get that headline 12.4% per annum. So for example, if on the first anniversary of the product being set up, those markets are the same or higher as they were at the start, the product would end at that point giving us the 12.4% return. If not, it rolls on to the second year, and if the markets are the same or higher at that point, it would kick out at that point and give us 2 lots of 12.4% per annum, and so on up to 5 years. Now we think these are really attractive because not only do they have pretty high expected returns, they also have that higher degree of certainty than you get from just investing in the stock market. So we only need markets to go sideways, we don't need them to actually go up over that long term. So recently we've been adding to our defined returns exposure. Now we're adding to our exposure quite slowly because essentially, because these are fixed term products, we'd like to try and space out the potential maturity dates. And as we saw earlier, these products have done really well for us, being the best performing asset class over the last 12 months. And some of the products we buy are based solely on the FTSE 100, while others are based on both the FTSE and the S&P 500. But if we look over the past 3 years, putting our money into the defined returns products, which is the blue line on this chart, would have seen higher returns than if you'd bought either the FTSE in red or the S&P in green. So despite the excellent run for US equities recently, we've actually seen better returns from defined returns. So they've done better than the indices on which they're based, which is really attractive, really positive. So in essence, in portfolios, we've been adding to bonds and we've been adding to defined returns. And both of these, as I said, have really attractive potential returns in our view, but also that greater level of certainty than just investing in some of those other asset classes. For example, if we could put half of the portfolio in a bond that yielded 5% and half the portfolio in a defined returns product that yielded 10%, then we would expect perhaps 7.5% or gross return at least over the long term. And that would probably achieve the objectives of some of the portfolios. Now we're not going to do just that because we do believe that some of the other asset classes can return even more in the short term. But this shows you why we're really so positive about the potential for future returns. Now in the short term, of course, what will happen to those asset classes and all the others will be driven by what happens to interest rates and inflation and the economy and the potential for kind of wars in the Middle East or anything else. And those things we can't really predict, but we can say that there is some really good value in some of those asset classes, and over the long term we believe that will come to the fore. So we're very positive about the future returns of the portfolios and have been making some of those changes to try and capture those opportunities that may only be here for a very short time. So thank you for listening to us today. We hope you find these videos helpful and we'll do them again in the next quarter. Thanks very much.